and I'll share screen at some point.
Yeah, however you want to run it. The show's yours.
Okay. Do you want me to wait a few more minutes just to let people that are late, or do you want me to start?
Start. I don't like to give encouragement to people to show up late.
Okay. Okay. Well,
No,
hello, everyone. Sure. This is my name is Noah Rosenblatt. I'm the founder and CEO of UrbanDigs, and you guys will soon be seeing this technology more and more. So I'm very, very excited to join you. Just a little bit about me. Am I a hedge fund trader or a quant? No, I'm none of that kind of stuff. I am someone who, when I was 13 years old and I got bar mitzvah money, I wanted to invest in a stock for the first time because I was enamored by the stock market. So I bought Silicon Graphics because they made the video games that I was playing at the time when I was 13. And to me, that was a great company. So I lost money on that investment, but I learned a valuable lesson that I couldn't just go throw money at things. And it got me intrigued into the stock market. So I really think of myself as a trader first and real estate second. My partner, John Walkup, he's on this call also. He's great. He helped me build UrbanDigs, and you're going to be seeing a lot of him too. He's also very similar to me. He's kind of a trader first and real estate second. And a lot of what we do with UrbanDigs is kind of geared towards that mentality. But I'm telling you this story because, I've been following the market since I was 13 years old. I've been trading since I was about 13 years old. I was in high school trading Dell options in 1993 and 94. I used to hog the AOL lines in 95 and 96 at the university, at college, trading and watching the stock market. So I always wanted to figure out, and it took me a while to figure this out. I always wanted to figure out that there had to be something, something out there that gave you a competitive advantage in terms of understanding how the whole system works and when is it a ripe environment for stocks to go higher? When is it a ripe environment for stocks not to go higher? It's got to be more than just complete gambling. I always thought about that, and I always wondered, why is it that sometimes you see headlines of 20 million jobless claims, and then the stock market's up 500 points, and you see all these crazy things, and to answer that last question is the stock market is a imperfect discounting mechanism. Okay. That's what the stock market is. It's a discounting mechanism that is trying to look at all the data that's given and available to you at this moment in time and try to predict the next 6 to 12 months. I mean, they know they can't predict 2 years now. It's too far. And they also like to look past the near term. So that's why you have companies come out with great earnings, but their stock sells off. Okay. Sometimes you have the opposite. Sometimes you have 30 million jobless claims and the stock market roars. It's because it's already pricing in the near term. It knows what's going to happen over the next couple of weeks and the next month or so, and it's pricing that in. So when it gets that data, it's already past that point and it's looking ahead. That's why. So that's fine and dandy. But that doesn't really help you because that's all news related and headline related, and no one could wake up the next day and predict tomorrow's headline. That's what kind of causes shocks. So over the course of 10, 15 years, I started to realize something. I started to realize that there's the credit markets. And when I say credit markets, I'm not talking about your credit score. I'm not talking about, any of that kind of stuff. I'm not talking about mortgage rates. I'm talking about the trillions and trillions and trillions. And when I say trillions, you probably have 30 to 50 trillion dollars in overall market, somewhere around there. And then you got notional derivatives in the 500 trillions that are worth some of these credit default swaps and crazy instruments that are out there that lever, crazy levels. So you have this crazy shadow banking system that is kind of the driver of what makes the machine, the global economic machine, work. So let's just stop for a second. Let's think about the global economic machine as a bicycle, as a big 10-speed bicycle with those big old thin wheels, right? 10-speed bike. And those wheels, those big wheels, are all the banks that make the engine go. Because without banks, you don't have any of this happening, right? So you got your big banks, you got your small banks, you got your hedge funds, you got your pensions, everything. You got sovereign wealth funds, governments. I'm talking about all of that stuff, okay? At the end of the day, the bike has these gears, right? 10 gears. Gear 1, 2, 3, 4, 5. And usually when everything's working smoothly and the gears are greased, you can shift between gear 1 and 2 and it doesn't impact anything and you go faster. All that kind of good stuff. The machine works. However, when those gears start to break down, the overall bike doesn't turn and maybe the bike crashes, okay? So what are the gears? The gears are, one gear is the repo markets, the overnight repurchase agreement markets. Maybe there's a couple of $1 trillion dealt with there. One of those gears is treasuries, U.S. short-term treasuries. Another one of those gears is money market funds. Another one of those gears is the commercial paper market, okay? All of these different things. Another one of those gears is money market funds. Another one is euro dollars. All of these are trillions and trillions and trillions of dollars each, okay? And if one of those gears starts to fall, maybe it'll trickle into and affect another gear, okay? And that's what happened in 2007. And that's also what happened in late 2019, about 6-7 months ago, as well as earlier this year, okay? And the topic of this whole conversation was not Manhattan real estate. It was understanding the credit markets and all the stuff that's going on around, right? So the bike and the gears are those credit markets. Now, let me show you something. I'm going to do a share screen here. Give me a second. Okay. So could you guys see my screen? Okay.
Yeah. Yes.
Okay. So here's one of those charts that I like to look at. Okay. This is investment grade corporate bonds. Okay. So the corporate bond sector is another one of those trillions of dollars. The high yield corporates, these are all trillions of dollars. These are big markets. So what I'm doing is I'm looking at the BAA corporate bond market. So if you think of investment grade, you got investment grade, you got AAA, AA, single A, triple B, double B. Yeah. So this is like the bottom of the barrel of the investment grade, right? The worst of the worst. This is like the bottom. So I like to look at that because you want to look in the riskier part of the assets because that's where credit stress is going to show first. And that's the whole point of this, is trying to give you a different way of looking at things, right? And let's define credit stress, right? This happens to be corporate bonds yield to treasuries. So let's just, I'm going to stop sharing for a second. I don't know how I do that. All right, because I want you guys to see me for a second. Okay. Hopefully you guys can see me again. So here's what you got. You got treasury yields, which are safe, and you got investment grade bonds, which have a risk to it, right? Investment grade, it has a risk, not a heavy risk, but a risk, right? If I want a big risk, I can go to high yield and get more risk. That's another sector. So here's what you need to know. In times of distress, money is going to go into US dollars and US dollar safe assets. That includes treasuries, US treasuries, it's government-backed assets by the US government, as well as gold, but gold is a special situation type of thing and that could sell off. But gold is also looked upon as a safe haven. So in times of stress, money is going to go to US dollars, AKA cash. It's going to go into US treasuries and it's going to usually go into gold, right? So let's focus on the first two, US dollars and treasuries. In times of stress, if money's pouring into US treasuries, let's imagine this hand is treasuries, the US treasury yield is going to go down, okay? Because money's pouring into the US treasury market. So the yield's going to go lower. And let's just talk about the 10-year treasury, okay? At the same time, here's my corporate investment grade bond, right? BAA, all right, a little risky. If in times of stress, the risk, this is going to get more risky, the yield's going to go higher, all right? That's what happens with risk assets. With risk assets, they're selling off. It's called risk off. There's a risk off trade, right? In risk off trades, everything's selling off. And all risk assets are basically getting worse. And the yields on them are going higher. So if you think about it, in this dynamic of credit stress, and when the markets are getting triggered to the sell side, you're going to have 10-year treasury yields fall, and you're going to have investment grade yields rise, okay? This is what's going to happen. and the spread between these two things is going to widen, right? That spread, right, is captured. Let me go back to my screen now. Give me a second. Okay, that spread is this chart. Okay, it's the investment grade spread to 10-year treasuries. Okay, so why is that interesting to me? Well, because that's where it's going to be an indicator first. Let's go back to 2006 and 2007. All right, when this is a low number and this is declining, that is an environment that's ripe for equities to go higher. Okay, so like when this spread is low and it's a tight spread, that's telling you there's minimal credit stress in that gear of the credit markets. Like there's all different gears, okay? Minimal credit stress. When this starts to rise, and look at when this started to rise before the credit markets. This is August 2007. Look, it's even, late 2007 it started to rise. The warning came here first. And that's the whole point of this conversation, is to teach you guys, so from a trading perspective, I noticed this back in 2007 because I was following trading. I was like, that was my first time. I was like, oh my God, credit markets are really important. I really should start following this. I never realized this before. That was my first foray into it. I got really interested and I educated myself. Okay. And if you look at the stock market was still at record highs. So the credit markets were starting to dislocate and show a warning signal. Yeah, and the stock market was at high. So I was like, all right, well, this is bad. So someone's wrong. Either the credit markets are wrong or the stock markets are wrong. And I'm here to tell you, when of those two things, credit markets or stock markets, 9 out of 10 times the stock market will be wrong. And ultimately, the stock market's going to react later to distress in these markets. The higher this goes, the more distress in the market. So now let's take a look at what happened throughout 2007. You're still in 2007. Look at that pop. You still had a chance to get out of stocks before the collapse with this. And you would have had a great alert. You would have gotten cash. You would have bought US treasuries. Maybe you bought some volatility just in case. And you would have sold off some positions and you got into cash and just chilled out. You would have missed the downside. Look at what happened here. The stock market got destroyed during this time. And on the same token, look when this started coming back down. May 2009. Look, mid-May, June. Imagine buying stocks. Imagine buying stocks as this was going down. You guys know what happened then. We already bottomed and we started a multi-year inflation. All right, we had a couple hiccups and this accurately predicted it, but it didn't full-fledged become a crisis. Like, that's the thing with this indicator. It will show you short-term blips. This was a crazy crisis. Now look at what happened here. Look at what happened here. Let me just make this a little smaller. I can go 1 year. Okay, look at this. All right, this started deviating on February 27th. Let me just go to that day. February 27th. You see that point right there? This is what I go to every single day. At that point, it was at around, for the longest time, it was around 2. It was around 2. And I'm like, all right, if this gets 10% higher, it's deviating. And right around February 27th or so, it went to 2.27. And this updates once a day. Once a day. So every day at the end of the day, I check it. Okay. So it's not a real-time intraday thing that's updating 100 times a day. This is updates once a day. So on February 27th, it went to 2.27. So what I did, and I encourage you guys to do this. All right. I have a YouTube channel. All right. Give me a second. I want to show you guys this. And I'm going to go to UrbanDigs and get to my YouTube channel. Okay. Here's the YouTube channel. And what I did is, let me X this out, is I discussed it. Let me go to my video. Sorry. I want to show you guys this because you may want to watch this video as well. Okay. Right here. Watching credit spreads during stock sell-offs. That was on February 27th. And so the deviation happened. Okay, so now let's do another thing and let's look at the stock market. Oh, I actually had the stock market up. S&P 500. Okay, and let's look at a chart and let's go back to just 6 months so we can kind of pinpoint it. Bear with me. Okay. On February 27th, where were we? Right here. right there. Okay, just below 3,000 on the S&P 500. Now, if you ask me, well, what about the days prior? I would go back to you and say, let me go back. We started rising on the days prior. You know, it's only on February 27th, 28th when you really hit that deviation. But it started to go up. If you watch this on a daily basis, it started reversing a few days prior. And over here, it started reversing as well. Over here was your first indicator, right? So you could have taken that alert signal. And again, that's just a signal. That's a signal for you to be like, all right, I got to be careful. You could have easily been February 25th, S&P 500 at 3128. Okay, 3128. It went to a different screen here. Ultimately, the stock market fell about another 23% from that point. Ultimately. All right, I'll go back to that chart. All right, ultimately, if you would have missed it. And in fact, you would have profited off it because the treasuries you would have bought would have increased in value. Okay, so now you're looking at this and it's coming down. And it's coming down. So like this has been in relation to the rally lately. As long as this goes down, I'm holding I got long stocks, right? I've been following this. This is my guide. And when it reverses, I'm like, all right, now I'm going to get out of my volatility positions, get out of my, other treasury positions that were good. And I'm going to go start nibbling. I'm going to start putting my cash to work and buying stocks. And when I say buying stocks, I'm buying companies that I know very well. I'm also in companies that I think are going to do well during this crisis, which I think are going to be the miners and gold. But I mean, again, you can't look at it now because they've moved up so high. Gold has moved up well over the last 6-7 weeks, but those are the positions that are kind of safety, right? So now that this is coming down, if this continues to come down, I'm going to hold my long stocks. I'm just going to let it ride. Even if that means we have a couple 100 points down or 500 points down or 2 days or 600 points down, instead of selling, I'm going to basically just accumulate my position more and more and deploy more capital as long as this is falling. All right. So this is at 3.33. It got as high as 4.23. Okay. That's how high it got. We've been coming back the other way. That's just one. Here's another one. Here's overnight repurchases. This is all the Fed. This is all the Fed data, Federal Reserve. Okay. And if you're wondering, well, why doesn't it, where's the chart before that? And the answer is it was at zero. There was no need for it. This is the repurchase agreements. This is what I was saying. This is one of those gears. Okay. It's repurchase agreements. And there's trillions of dollars, foreign exchange swaps, other swaps of collateral swaps, crazy things going on. One day repurchase. I need to borrow, 500 billion and I'll give it back to you tomorrow. So here's my collateral. The Fed does it. So if the market's working, there'll be no need for it. So now let's think back to what happened. This was in 2019. 2019. Now, if you talk to a fixed income specialist or anyone that understands the credit markets and you talk to them, they are going to tell you that the first credit warning sign stress, the first gear to go haywire was the repo markets. And John and I discussed this. We visit firms and we do classes, and sometimes they ask us to talk a little high level, and we do. And we discussed how the repo markets, the Fed repo markets are doing crazy things, and the Fed's got to inject liquidity into those markets. And this chart is showing you that liquidity that they're injecting. That's what this is. Okay. Here's another one of looking at it. Here's the repurchase agreements. And this was 2019. So anyone that was looking at this stuff, their alert just went flashing high. Now the bike was still running because you had 9 other gears that weren't really impacted yet. But come February, come like mid-February, all those gears, and this right here, this investment grade bond to spread treasury, this pretty much will help you cover most of the gears without going into individual charts, because this is your indicator of credit stress. It's that simple. If it rises, something bad's happening. If it's falling, something is getting better. And if it's low and it stays low, then you're in an environment that is greased and the wheels are free to move and stocks could go higher. Like, again, not to say day trade isn't kept down. You wake up tomorrow and there's a headline risk, that could happen. But, in that sense, this is a lag. But in general, this is telling you when there's a problem to worry about. Does that make sense? Is everyone still there? There may be some questions here. Let me see if I got some questions.
Yeah, we're still here. I'll actually put the I'll put that URL in the chat.
Yeah. So what happens if the dollar drops during time of stress? I mean, usually that doesn't happen. Let me see if I can whip up a US dollar chart here. Give me a second, and then I'll put you guys on. Here we go. Okay, hold on a second. I got it here. It's a small chart though, but let me put you guys on screen share first, and we can figure this out. And Jared, if there's any questions, maybe you can read it because I can't see it. But here's a chart. Here's a small chart. Sorry, it's so small. But here's a US dollar chart. Look at that spike in the US dollar in March. You see that right in March? That spike right there. That coincided with our steep sell-off. And that coincided with credit. Because what happens is you start to have liquidation events. And that's when all of your trades for risk parity go off. And risk parity, I mean, I'm going to hedge. Right. I got stocks. I'm long stocks, but I want a little bit of a hedge. So I want some treasury bonds, which, you know, it's not going to do so great if the stock market go up. It'll do okay. But I mean, if it's really a protection if it goes down. Now, sometimes when you're in steep sell-offs and credit gets really crazy, and just to give you guys an idea, this happened about 4 weeks ago. If you think back to March 10th, March 11th, March 12th, March 13th, even right afterwards, March 13th was the low, March 14th and 15th, right around that period. That was your height of fear. That was when we were in the depths of hell. Okay. At that time, there were liquidations and there were redemptions, meaning large funds, whether it's sovereign wealth funds, whether it's hedge funds, whatever. If there are redemptions, all right, pension account funds, if there are redemptions and you get, all right, I got to sell fucking $50 billion worth of positions. Why? Because I just got a redemption call and I need to come up with cash. So those guys have a choice. Now again, you're in a steep sell-off. If you think of where Boeing was and all these other positions were back 3-4 weeks ago, oh my God, they were down 70%. The travel industry, casino industry, energy sector. I mean, let's not forget, we've had two crises here. We've had this global virus pandemic and an economic shutdown, and we've also had an oil price war with the Saudis and the Russians that drove oil price way down, killing the energy sector. There's a lot of jobs and a lot of wealth and a lot of derivative contracts and trades based on the energy sector, right? And 4 weeks ago, it was a disaster. All those guys had liquidation events and redemptions causing the US dollar to be in great demand. That's one reason why the Fed had to come in with trillions and trillions of dollars for the repo market to stop the US dollar from rising.
So, Noah, can you hear me?
Yes.
So, John Chella here. How you doing?
Hey, John, how are you?
Good. So, you just said that the Fed printed all this money. So, when you base it off of the basic economics of it, and you increase the supply that much, wouldn't it lessen the value and lessen the purchasing power?
So let's talk about that. So when you say printing money, we gotta talk about that. So
they're literally printing money.
Yeah. So let's just talk about how they do that. So basically, what the Fed does, and again, I am not an expert on this. However, I believe that I understand how this works. Okay. I'll just say that. Okay. So here's how I believe it works. The Fed has a trading desk. Okay. And they do permanent open market operations. You guys can Google this, right? POMO Fed operations. Type that into Google. Permanent open market operations. They do this with about 17 different primary dealers. These are certified large institutions. Think Goldman Sachs, Morgan Stanley, Citibank, et cetera, et cetera. These types of institutions have a direct account with the Federal Reserve. Okay. This is the method to which the Fed injects or contracts liquidity. Okay. Now, how does that work? So you're talking about printing money. Let's just explain. They are besides the fiscal. What happened on the fiscal side? This is monetary. The Fed and printing money helicopter, that's monetary, Fed. The fiscal side is government. Fiscal, that printed money, that check that you got is literally printed money. Okay. But the Fed, when they're printing money, is a little different. What they're doing is on their trading desk, permanent open market operations with the primary dealers, is they're buying and selling assets from those primary dealers. And the primary dealers, it's not like they have a choice. It's not like hey man, you want this? It's not like that. What it is the Fed is controlling the money supply via this desk. And what they do is imagine the Fed at a computer with a mouse click. And they want to add liquidity. They want to print money, so to speak, right? So they go and they have to buy something from the primary dealer. So the primary dealers got, say, $100 billion of investment grade corporate bonds or high yield corporate bonds that are now a bad news on their books. It's starting to hinder them. They want it off their books. The Fed said they're going to go buy corporate bond debt. All right. So now the Fed goes and buys that corporate bond. Well, what do they buy it with? Where's the money? It didn't exist. They buy it with a mouse click. And what happens is the JP Morgan, who had the $100 billion bond, sells that bond to the Fed. The Fed now assumes $100 billion of the investment grade bonds onto their debt sheet, their balance sheet, as an asset, I guess. And the money is now deposited into JP Morgan's account for $100 billion in cash. So JP Morgan now has $100 billion. So what is JP Morgan doing with that money? Okay. Now, in a typical situation, they would be lending it. Okay. Like lending it. That $100 billion now is lent. It's lent it to small businesses. It's lent to consumers, et cetera, et cetera. And it starts what we have as a this is getting a little high level. It's a multiplier effect. It's called velocity of money. Okay. Meaning we have a fractional reserve banking system. You put $10,000 into that bank. All right. They're only required to keep 1,000. They take that 9,000, they're investing it and they're putting it into someone's mortgage or whatever at a higher percentage rate. So they're levering up. It's fractional reserve banking. Same thing with credit. Okay. This is getting the money is getting multiplied and multiplied and multiplied, creating credit and credit and credit until all of a sudden you have debt credit deflation and everything collapses and there's bankruptcies, which you're in now. This is debt deflation. Okay. So printing money, it's not getting to us. Like the banks are not taking that $100 billion and giving loans to us. Quite the opposite. They're contracting lending. Instead, they're keeping it on their books in excess reserves. So that money is not being injected. It's sterilized. And that's why it's not going to cause inflation or hyperinflation. Okay. Now, the inflation you're going to see is going to be in assets. It's going to be in hard assets, ultimately. It's going to be in the price of commodities. You're going to likely see a stagflation scenario where the price of food and commodities. Honestly, I think the price of oil in 2 years from now is going to be very different than where it is today. You know, gold, metals, resources, other stuff. I mean, that's the kind of stuff typically that rise. You have the stagflation. You have economic deflation, you know, and job deflation, and it's not a great time economically. But at the same time, the cost of the supply side. The supply side's totally shut down right now. It's not a demand. The demand is gone, but the supply side is just totally shut down from the global thing. So you have a demand shock. Everyone's isolated. You got a demand shock, global shutdown, supply shock. So you have these massive deflationary forces. So the Fed is going to keep injecting money through these permanent open market operations. They've already added, I believe, 2.3 trillion. So I believe, and you could check this out. You could go to let's go to the Fed. Fed. What do they call it? I think it's called asset purchases. Let's see if I can find the chart on this. All right, but you got to Google this. No, that's not the right chart. But I mean, there's charts on this Fed. Let me see. Balance sheet. See if it shows here. Yeah, I'm sorry I didn't have this one up. But these are the kind of searches you can do and try to find out some balance sheet trends. There it is. Do you guys see this? All right, so it was at 3.7 trillion, and now it's at 6.3 trillion. You see that right there? That 2.3 trillion is the Fed purchasing assets from primary dealers through permanent open market operations trading desk. That's basically printed money. But that printed money, now I can go look. Now let me show you something else, right? Let me go to Google here. Which Google? Oh, here it is. And now I can go and see bank excess reserves, right? Let's see what's going on here. I didn't even check this. Fed. Excess reserves, depository institutions, and see what's going on here. Hopefully I'm right here. Whoop, there it is. Do you see, guys? Right there. See that? You know, so it's already popping. And you can see what, you know, what it did. What it did after 9/11 was, I mean, sorry, after the credit crisis was the same thing. Excess reserve just kind of just ballooned. And that's money that's sitting on the bank's balance sheet. It's just not, the Fed's paying interest on that. The Fed's paying them interest. So think about this from a bank standpoint. They sell a bad bond. They get a toxic asset off their books. It makes the bank's balance sheet better. The Fed assumes the toxic balance sheet. I don't know at what price. Now the bank has the printed money that wasn't in existence before, but now it is. In a credit-based system, you could do this digitally. So now JP Morgan has that money. They're taking that money and they're putting it into excess reserves. Just to boost the balance sheets. And that excess reserves is earning interest. That is how the banks recapitalized after the credit crisis, is through excess reserves. And look, here it is again, you know, and that's how they recapitalize. That's because now the Fed is just paying them hundreds of millions of dollars just for leaving that money there. And that's how they sterilized inflation. Because if that money is not being lent and multiplied, and that small business is now hiring people, and there's no wage inflation. I mean, that's the kind of inflation you worry about economically, is wage inflation. We got no wage inflation. We got massive deflation right now. Massive deflation. And what the Fed is trying to do is reliquify the credit market so that there's no credit event. They're trying to mitigate a credit event. They're trying to prevent the Lehman Brothers. And make no mistake about it, they have taken massive, massive measures, and they came on very, very quick. Okay? Very, very quick. So I think at the end of the day that they are going to successfully mitigate a credit event. Like imagine, like we had Lehman Brothers and Bear Stearns in 2008, 2009 credit crisis. Okay? We had Lehman Brothers and Bear Stearns. So far, we have not woken up to a Boeing being nationalized or a Schlumberger energy sector going bankrupt. We have not woken up to a credit event. And that's why the Fed did what they did. And the Fed was ahead of the curve. The fiscal, the government side fiscal checks to people, small businesses, all that's government. That's the US government side, Congress, right? The monetary side is the Federal Reserve. And at the end of the day, so the Fed's balance sheet is 6.3 trillion. Right now, you just saw it before. It's up from 3.7 to 6.3. That's going to freaking go. I wouldn't be surprised if that's over 10 trillion by this time next year. And I wouldn't be surprised if it's close to 20 trillion by the time this is done. Because why do I say that? Because you got to think outside the box. And what I mean by that is think about the banks and the mortgage-backed securities that are behind everything. Think about the commercial sector, the commercial mortgage-backed securities market. Okay, all of those strip malls, all of those huge buildings, all of those office spaces where people are not paying rent for however long it's going to be, and we're in inning 4 or 5 of it now. You know, we're midway through hopefully this game. We're definitely not in the beginning of it. And how does that affect all the commercial mortgage-backed securities and the lenders and the mezzanine lenders and all those guys that now don't have the money coming in? What are those bonds worth? How many write that? I mean, this is how it exasperates and becomes a credit crisis. This is why I describe this. This is like a sick mad child of 9/11 in terms of shutdown and fear, much greater than that. And this is a mad child 9/11 and 2008, 2009. It's turning into a credit crisis. The reason I feel better is because the Fed came in so early and came in so deep. Like they put trillions in. They're like, all right. So you have to understand 2008, 2009, like they didn't understand any of this stuff. Like the credit crisis back then was the first time they saw it. And it was focused on the mortgage-backed security markets. The mortgage-backed security markets. It was really isolated there. And there was a playbook ultimately taken out of that whole system. So, but it took them months It took them months and months and months and months to really figure out and get the approvals and figure out what to do. And ultimately, we had two events. We had Bear Stearns and Lehman Brothers. Okay. This time, they saw it really quick, and they looked at those charts, and all those guys are looking at those charts, and they're like, oh, shit. And they probably talked to a bunch of hedge fund guys and guys on the other side. They're like, this is blowing up in your face right now. And like, all right, I've seen this before, you know. And they came in and they threw trillions to liquefy the credit markets early on. Most people didn't understand, and the reaction of people was, "Wow, that's inflationary." And I kind of like laugh in the back of my head, you know, not to insult you at all. It has nothing to do with that, but it's not. It's very deflationary, because if you think about it, why do they need to throw trillions and trillions and trillions and trillions of dollars into this? You know, and it's because those credit markets are so large that the Fed is trapped. They are trapped. And now put aside right or wrong. We're way beyond right or wrong here. Okay. The Fed is trapped. There's nothing they can do. They have two alternatives. They could do what they're doing and provide all the stimulus and basically say unlimited. Guys, unlimited. Whenever it gets bad, we are going to come in, right? And just print until the markets deem that that's not even good anymore, right? Or option two, let it all implode. And let the economic credit system collapse, the trillions and trillions and hundreds of trillions of notional derivatives, let all that collapse on itself. And what you're going to see in that scenario is stock markets down 75 or 80% without rallying, just straight down. You're going to see unemployment rates of 40 to 50%. You're going to see crazy, crazy, crazy society problems. It'll be a complete depression like you've never seen before. So they have no choice. They are trapped. They only have one choice. And that choice is just to keep it freaking going. And that's the trap. They're in a liquidity trap. So they're just going to have to provide liquidity over and over and over and over again, unless you believe that we're going to bring on a Volcker. And I've tweeted about this. Like, we're going to at some point need a modern day Volcker that's going to have to just say, all right, you're all swallowing a bad pill. Interest rates are going to go a lot higher, but we got to reverse all this and take all this out of the system. I mean, unless you believe, it's not going to be politically good thing to do. It's suicide, because you're basically assuring everyone that the stock market's going to collapse, credit markets are going to collapse, it's going to all deflate, and that all is going away, and it's going to hurt homeowners, it's going to kill credit cards. We're not going to be able to finance our debt. Like, it's just you can't do it. Like, they're going to do this until they could no longer do it anymore.
Right. Until then, it's almost like it's just a compounding house of cards.
Yeah, well, I can't even fathom what it's going to look like one day. Like, if we call it, and there's a bunch of people out there that talk about this kind of stuff. Usually they're like high level CFOs or stuff, high end hedge fund guys, but they talk about end game. Like, what is end game of all this? And a lot of them talk about it's a currency crisis. A currency crisis meaning every central bank around the globe is literally trying to print money and solve this. And they're trying to debase their currency. It's a race to debase, because everyone's trying to stimulate. So if everyone's trying to stimulate at the same time, which currency is relatively strong to another? And at the end of the day, most people say the dollar. At the end of the day, the dollar is king of the turds. We're the best looking shit in all the shit.
Bitcoin.
Yeah.
So another question that was popped in here, switching gears a little bit. So Noah, you had spoken to Amir this week. So
Yeah.
Seth Odell is asking a question that Amir noticeably sounded a lot more bearish than your outlooks. So do you share some of the same concerns about the residential market in regards to developers going bankrupt, owner foreclosures, things like that?
Yeah, I believe Amir mentioned also the commercial sector. I think the commercial sector is definitely going to get hit. The duration of that's going to be a lot worse for them than for residential. But yeah, no, he did say that. So here's, again, let's think outside the box, okay? Because I agree with him and I disagree with him. But when I disagree with him, I almost think like we're saying the same thing. In terms of the price dislocation revealing itself, in terms of price discovery, in terms of sales data that shows Corona, let's be very clear about that. I totally agree with him. So like over the next, not 1 or 2 months, because I think the next 1 or 2 months still has the good stuff from 3 or 4 months ago that hasn't funneled through yet, because that's the lagging nature of sales. Sales are not real time. They're lagging. They show what happened 3 to 5 or 4 to 6 months ago. So in that vein, we were doing well. So that January, February, that stuff is yet to filter through. So we have a couple of months of good. So, but month 3, 4, 5, 6, 7, 8, think July, August, September, October. These things always tend to show up later for some reason. I always think July and August, and then it ends up being September and October and November. That is going to show your Corona trades. So let's just think. So here I am talking with Amir, right? And I'm like, Amir's like, it's going to be bad. It's going to be bad for a while, right? And I'm like, well, I think now, this is where I slightly disagree. I think the dislocation in terms of the deals, the biggest discounts you can get, has already happened. Like, I look at this as a dislocation period. Dislocation period, meaning this is going to last for 4 to 6 months. It's just going to be like this, because even when restrictions are eased, it's still going to be, it's not going to be business as usual. It's going to take time. But in this dislocated period of 4 to 6 months, we're going to have different windows of worse dislocation. And right now, if I think back to the beginning period, inning 1, inning 2, inning 3, we're at inning 4 or 5. Inning 1, inning 2, or inning 3, let's even consider it weeks, right? Though that was March, early March, mid-March, late March. If you signed a contract on March 9th, 10th, 11th, 12th, 13th, 14th, 15th, you get my point. Right around that period, you got a much larger discount than you're getting today if you're signing a contract or getting an accepted offer. Okay, because the fear level today is not nearly as acute and severe as it was 4 weeks ago. It just isn't. I mean, the stock market was at the depths of hell 4 weeks ago. We weren't sure the numbers, how bad they're going to be. We had a lot of more unanswered questions. Since then, we've had a 20+% rally. Everyone's believing the Fed injections are working. Credit markets have gotten better and better and better, right? So all this stuff has happened. And it's just different. So sellers are like, all right, maybe I will wait this out, as opposed to 4 weeks ago when it's like, oh shit, how bad does this really get? So the gap, the spread was the widest 4 weeks ago in that dislocation. If I was going to put my money to work, 4 weeks ago was the time to do it. Not to say that you're not dislocated now. We are, but not as much as we were there. And we could go and retest the lows. There could be another bound of volatility. I mean, I don't think the news is going to be good over the next 3 months. But the thing is, did the stock market price this in? I mean, you got to think about the stock market. I always like to say the stock market is our stars. And what I mean is that's kind of what people look to gauge whether or not information is deemed good or bad, right? And sometimes like for example, we could go in the next 2 months and get terrible data. And the worst of it is early June. So for the next 6 weeks, the data is proof. But every single day we wake up to bad news, the stock market goes up.
Right.
And then you wake up in June one day and the news is better and the stock market really rallies. Right. Like, what the hell? If that happens, it's not going to be as severe. However, if the bad news comes out the same way, but the stock market falls another 20% and we're now at lows and we're making lows and the credit markets are getting worse, then yeah, that's going to be a wider discount that the seller's more likely to hit that gap down bid. Hit the gap down bid. That's the key right there. And the question is how many sellers are really willing to hit that bid?
And to piggyback, so we're seeing, if the pain continues to extend for an additional period of time, right? Like we've priced in, so to speak, that we'll be out of this in 30 or 45 days, restrictions start to ease, things like that. I mean, Cuomo just announced today that the lockdown is not sustainable and they want to figure out a way to move forward responsibly as soon as possible to start releasing some of that. So provided that this happens, that's sort of, accepted now, right? But if this continues for longer than we think and economic pain, ratchets it up, then that could be a second wave of buying opportunity. But assuming that doesn't happen, what's interesting is to your point about it not hitting the data until late summer next or fall and into the winter, is then you're going to have another wave of buyers that are coming on the market in the winter, early next spring, that are looking at saying, well, what happened last year? And then that compounds it. So even though the market wouldn't necessarily warrant those decreases, now you have a less than educated buyer looking at these numbers and saying, well, the market was down, I want to pay even less than that. And that almost in and of itself makes our job hard and compounds this.
No, I get it. And you're totally right. And that's why agents need to kind of you know, you need to kind of get out there now and say these things now and manage expectations now and get on record now. So when 4 or 5 months ago, 4 or 5 months from now comes, you can actually say, well, listen, I've written about this back in April, explaining what's going to happen. This is not the industry.
Let's lock in a date for your next podcast then. I'm happy to go back and forth with you on that. We're also seeing the spread, right? The bid-ask spread increase now because you have the percentage of sellers that are decreasing their pricing is decreasing, right? Like you have a higher proportion of sellers that don't want to drop the prices, and you have an ever-expanding proportion of buyers that want a discount. So the bid-ask spread that was narrowing in the first quarter is now starting to greatly expand.
Yeah, and that's how I like to look at it. And when that spread expands, you have low volume markets, and that's exactly what we're in. We're in a dislocated, low volume, thinly traded market. There's look. Let me show you. Let me show you guys something. How do I go to the presentation here? Okay, and let me just get to UrbanDigs really quick. And you guys, this is what you guys should be doing. All right, this is what you should be doing. And what I do is I use my search tool, okay? And I'm going to add month to date on here and quarter to date and quarter, so you can do that. But for now, I'm going to use my custom tool and just do April 1st to April 16th. And what I'm trying to do is I'm trying to get a month to date look at deal volume, right? So you could look at this, look at contract signed. And you could say there's 127 deals. So far this month, 127. That should be more like 1,000. We bring in at least how do I know that? You know, we bring in 2,000 units of new inventory every April. All right, I go to my chart room. Here's my chart room. I scroll down to monthly new supply. That's my monthly supply level. I'm going to click my 3-year button because I like to simplify everything. And I go to April, and I can see over the last 3 years, the average is around 2,000 is how much comes on, right? Look at March. Look at last month. We usually average 1,780. We brought in 924. But March wasn't a full month of exposure. March was 1.5 weeks of exposure, 2 weeks maybe, right? April's our first full month of exposure to this whole thing. So we got 127. So we're going to have 250 listings coming on. So this is why supply is going, let me go back to the charts. This is why supply is going way, way down. And what you guys should be doing, look, I could look at active. Let me look at active here. That was contract signed 127. Here's active 151. 151. So 300 listings now. 300 listings are going to come on the market when usually 2,000 come on. That's a hell of a lot less. So I look at my supply chart. Here's my supply chart. Generate the chart. 3 years. I like my 3-year button. Supply is just tanking. Completely tanking right now. Usually this rises. Like if I go back to last year, look at February, March, April. Look at this. Look at it rising up to June. Look at the year before. Rising up to June. We usually rise. We should be at 7,000 plus right now or close to 7,000, you know, and we weren't. We're going straight down. So where does this look in 2-3 more weeks? Is that 4,400, 4,500, 4,600? Where does it look? Where does it look at May 10th? You know what I'm saying? May 15th. Where does it look like when we come out of it? And when we come out of it, is you know, our buyers and sellers are all coming back at the same time. Like, I don't think it's going to be a switch. So what I'm doing is I'm using this tool, and what I'm doing is I'm doing a weekly look. So I go to 1 week, all right, and I toggle between my statuses. So I go 1 week active, and I usually do this on Friday. So every Friday. So today, when I'm done with you guys in the afternoon, I'm going to do my weekly report, and I'm going to go through this, right? But this is what I'm doing. This is what you guys should be doing. And the purpose, the narrative, the agenda is transparency and comfort for clients that are looking to have an understanding of what's going on out there. And trust me, they are. And if you can give them some transparency and some data and a narrative of what's going on. Oh, here's a narrative. I checked this week. We brought 71 listings on the market this week. Okay. We put in, how many contracts were signed this week? Let's see. 47. How many listings came off the market? 121. Okay, and do this every week. And what you're looking for is you're looking for active inventory to go up, contract signed to go up, and off market to go down. That's what you're looking for.
No, a couple questions coming in here. So
Sure.
Peter's commenting, so supply's down because they're holding back the inventory, right? So it's shadow inventory, right? It's not really gone.
So let's look. We could look at that. So it's a combination of a couple of forces. Number one, it's a lot less listings coming on. That's obviously not measurable, right? We don't know how big that is. We don't know what it would have been otherwise. So a lot less listings coming on, in addition to a lot of listings that were on that are going off market. And that is what I think you call shadow. And yes, we can track that. And here, let me just do my 3-year chart. So this is off market. And again, this is supposed to be falling. Like if you look back to usual, this falls until about May, June. You know, it goes down. We're going up. And we're going up because all these listings are going off the market. So it's a combination of listings coming off the market, listings going into contract, which obviously is much lower, and much far fewer listings coming on the market. That's the biggest force, is that we're having so few listings come on the market. And the narrative is to buyers, like they got a false sense of hope because, you know, they were going into this having all the options in the world. Like that was one of the things that they had going for them, is they had a lot of options. And they've had a lot of options during this downturn. Supply was a challenge. And now they're looking for discounts and they're like, oh, great. I was down before. I'm going to get another 20% off. And the answer is like, no, because number one, there's a lot less inventory for you guys to browse from, a lot less. And number two, of that, you know, constricted inventory, abnormally low inventory, how many sellers are really willing to entertain a bid down 20, 25%? So you got to think that way. Buyers are submitting bids, low bids. Most buyers are not like, all right, this will pass. Let me pay you fair market value. No, and buyers are bidding down 20%, 25%, 30%. They're seeing what they can get because the buyers that are out there right now are opportunistic, fear of missing out buyers. And sellers are like, nah, I'll buy my time. And that's why it's such a thinly traded, low volume market. And sellers have every right to do that. So we have to manage expectations. Sellers need to be managed in the sense that, listen, I can't show this thing, you know, but the bids that are coming in right now are not optimal bids. Just wherever we price, I would expect to do a deal 8 to 10% lower. Honestly, I would price and expect to do a deal 8 to 10% lower. If you can get a buyer to be willing to expect, like that, buyers need to understand that if you're going to put in bids down 20, 25%, that may work for 10 or 15% of properties out there where sellers are forced to sell and you're the only option.
That's why we want to look. That's what, you know, Kevin and I have been talking to you about, looking at the ones that are still dropping prices now, because the ones that are on the market now dropping 10%, and especially the ones that are vacant, that's a clear, you know, indicator of a motivated seller. Not 100% accuracy, but like if you're narrowing these down, you're finding properties that are coming off right now.
Look at price reductions. Look at price reductions. If you're a seller right now and you need to sell, and you're one of those people like, I got to get out, I got to liquidate, I need money, I got a margin call, whatever. It should show in price reductions. You could do a search for price reductions on UrbanDigs and take a look there. I don't think you're seeing as many as you otherwise would have seen. I really don't, because I think sellers don't want any part of this market in general.
Yeah, I think also what's happening now and will happen in the short term with the increased restrictions or increased, scarcity of credit, right, on the mortgage side, right? The restrictions or the limits are going up, right?
They're constraining, and that's what happens in times of deflation. And they did the same thing in 2009. So 700 credit score. JP Morgan wants at least 700 credit score. LTVs are going the wrong way. They're asking for more money down. And not only that, but I was talking to Adam Kirkowitz, who's a great lender, and he's really smart. I'm actually going to do a podcast with him next week. He's really smart. He was telling me, watch out for all those deals that were in contract that are not closing because of this, and their loan commitments are expiring. He's like, it's already a problem, and now we have to ask them for new updated employment information, and that may have changed.
And if the bank no longer wants to take that risk and things like that at their credit scores or anything,
it just doesn't help. It's not a helpful thing when you're it's making things tighter. Listen, Peter has a question. Supply is only down because everyone's holding back inventory. Supply will be off the chart in the next few months. Looking at supply now is irrelevant. So listen, I agree with you. That's exactly what I said. I mean, supply is off. The main force is supply is down because far fewer listings are coming on the market. Now, here's the thing. I disagree with you that it's going to be off the chart in the next few months. I just don't know if this is going to come back like a light switch. And listen, this is a respectful conversation. I think we're going to come out of this at a much lower inventory level. And again, we might be in the 4,000s. It looks like we're going to be in the 4,000s. So now let's say May 15th. Let's say May 15th. Yeah, we'll put aside your deflationary things. Let's say May 15th happens. Is everyone going to go back to the safety and security of just mass showings by then and open houses? Will buildings allow it? Like, these are things we're not. Are buildings? I'm hearing buildings. They're going to say, you know what? Even when they allow it, I'm not going to allow open houses. All right. That's a thing that's going to happen. Everyone has their own kind of like unique perspective of security and safety. And what you feel safe doing may be different than what this guy feels safe doing. And I'm just saying that there might be a batch of inventory where sellers are, number one, either in this category of like, you know what, I'm just choosing not to sell right now. Or number two, they're like, you know what, I do want to sell right now, but I'm not really comfortable and I want to wait a little longer. So I think it's going to be more like phases coming back inventory. I don't think it's going to be March 16th. We have 3,000, 4,000. We used to see 1,000 or 2,000. Now we're seeing 3,000, 4,000. I don't think that's going to happen. Time will tell. If you're right, Peter, I'm going to certainly email you and give you all the respect and credit in the world. I just don't think it's going to play out this way. I think it's going to be much tighter inventory than we used to for the next 4 to 6 months minimum.
Keep in mind, too, a buyer can mobilize much quicker than a seller. So a buyer can wake up tomorrow and say, I want to go out and look at apartments. It takes a week of a lead time minimum for a seller to put their apartment on the market and show their intent. So there's also that lead time there that you have to be aware of as well.
Yeah, and these are good questions in the comments. Look, everything he's talking about is right. All right, this is massive. He's asking about add unemployment, defaults, and loss. Look, massive. This is massive deflationary forces. I mean, I'm not disagreeing with you, Peter. I'm agreeing. This is massive deflationary forces. All I'm saying is that I think with all of the stimulus going on, combined with the fact that I don't think mass sellers are hitting bids. They're not hitting bids. If they were, we would have 1,000 contracts signed right now. If mass sellers were hitting bids, they're not. We had 126. That's not a lot. So I think that this period is going to be an illiquid, thinly. This is like February, March, April, May, June, July, August, 2009. This is exactly like that. And it's going to last a long period. It's going to last 6 months. It's going to be a dislocated period. But within that period, you're going to have acute phases and windows of more severe dislocation. My point is that if you signed the deal and had an accepted offer on March 10th and March 12th and March 13th, versus if you had an accepted offer on April 16th and April 17th, the dislocation will be different. All right. And measuring all this is going to be so hard because it's going to be, I mean, what are we going to measure? I mean, at the end of the day, we're going to look at 500 sales. What if over the next 4 months, 700 deals got signed in total? You know what I'm saying? When we usually will see 7,000. And we're going to analyze that. And of the 700 deals, 300 are over 5 million. Or whatever, 205 million, and the rest are dislocated. You're not going to have a lot of comps. You're going to have very few liquid price discovery, to really go after them. And it's going to be very case by case specific. Some of them, you might have a situation where there was only one bid, and that bid was 25% down, and that seller was scared out of his mind, and he hit the bid. Another situation is, all right, yeah, I had 2 or 3 bids, but they're only 10% down. So are we down 30% or are we down 10%? That's the whole point of a dislocated window. Both of them are right. For this guy's down 30, for this guy's 10. There's no market, and this is going to be like this for a while. We're agreeing. We are agreeing with each other. Now, you guys are saying 12 to 18 months. I think ultimately the rebound's going to, you can't time this thing. If you're going to try to hit the bottom, you got to kind of buy when the fear is at the highest. So I think that period was actually 3-4 weeks ago. Time will tell. And if we muddle around this area or reflate, let's just talk out reflate. What's going to happen is we're going to get to Q3 and we're going to have 1 to 2 months of dislocation data. And then most likely after that, it's going to start to normalize a little. So you're going to have 1 to 2 months where it shows down big time. And then it's going to start to come back. And we're going to be sitting here saying, how does the reflation look? How long is it taking? 9/11 took a year. 9/11 took a year. 2009, it took us about 3-4 years. 3-4 years to kind of recover the 20. All right, so 2009 is a good example, right? I was hearing deals in the classic 6 market, 3 million deals, like a $3 million property. They were being bid at like 2 million, 2.1. They were bidding 35% down, and they were getting hit back in the depths of hell in 2009, right? But the under 1 million market really wasn't seeing that. So you had 30% dislocation in this sector, and you had a 10%, 15% dislocation in this sector. And I think the exact same thing's going to happen. And at the end of the day, if you looked at June 2009 and July 2009, those deals signed did not get those discounts that were signed in February and March of 2009. Even though the dislocation period was 6-7 months. At the end of the day, if you bought in 2009 and you held for 5 or 6 years, you did great. If you bought in February or March of 2009, you doubled your property because you gapped down 15% because that dislocated height of fear was so severe. But it was a very short window, very short period of time. So the question is the battle of stimulus versus deflation. I mean, they're throwing trillions at this. I think it's going to be more. I'm not saying it's right. I'm just saying that they're putting this reflationary stimulus. I do think there's going to be a reflationary wave after this whole thing's over. I think commercial's in pain. Retail, that's in pain. But for residential real estate, I mean, the fact that inventory is going down so much, I think the Fed stimulus, both of that thing is going to put like a floor on this. I don't think you're going to see New York City property down 50, 60, 70%. I do not think that's going to happen. And inflation will bring property up a touch. And yeah, there is no inflation right now. I mean, there's deflation, right? But ultimately, they're hoping for inflation, and that will come, and who knows when that might come. I don't know. All I know is that there's massive deflation right now. What happens when the sellers are forced to sell due to unemployment? And again, the question is, how many of those are there? I mean, that's a concern.
And keep in mind too, everyone has more skin in the game in New York than nationally, right? In the last crash, nationally, people were buying houses with as little as 3.5% down. Everyone has a lot more skin in the game buying in the city. So they have a little bit more sense.
Plus, we're not a heavy speculative market. We're not a Miami. We're not 85, 90% condos.
And half the market's cash.
Yeah, I mean, we gotta take into account these things. There's also going to be in inflationary times, people are going to look to put money in hard assets, and there might be a lot of foreign money that's going to be wanting to put into U.S. dollar-based assets, and New York City might be one of them. We don't know how we're going to get out of this. We don't know. We just don't know. I'm kind of like, look, there's two ways you can go here. There are people talking about how this is going to be a deglobalization event. This can be an isolationist event. All the countries are going to want to produce everything in-house. People are not going to want to travel anymore. Like there's crazy narratives out there that I don't listen to. I think we're going to get through this. I hope, of course I hope, but I mean, what if there's a treatment option? Like, what if there's a treatment option? Let's just think for a second. There's so many companies, amazing minds out there that are working on treatment. What if we could just make people stop dying? Like, I know there was a talk with the Gilead drug today that was debunked. I don't know if it's real or not, but Regeneron's working on something. There's 8 other companies that are in trials right now. What if one of them will just help people from stop dying? So now all of a sudden, like, that could expedite all this, because the vaccine's not going to get here until next year. And if you think about like stages of recovery, my thoughts are this all ends when Major League Baseball, the NBA, you can go to a Broadway show, you can go to the movie theaters, your concerts, all the mass events start happening again. And I have a feeling those guys are itching to get back, even though they can't right now, obviously, because of everything that's going on. But when they physically are told you can get back, that's a good indication of the fact that we're starting to get back to normal. I mean, I don't know when that is, but if there's a treatment, and that's now you got $6 trillion worth of stimulus, and plus I think this is going to 10 trillion, quite frankly. And I think it's going to 10 trillion, not so much because I think they're going to give it to us, which unfortunately is not the case. I think it's going to go to 10 trillion because I think the repo markets and the euro dollar markets and all these crazy markets offshore that might need US dollar funding based assets. They're going to need US dollars. The Fed's going to have to come in with trillions more to liquefy that. So, that's one thing. Johnson & Johnson, Novartis, all these companies are working on something. We got mad good Regeneron. I mean, they got mad scientists at Regen, and that stock looks like something's going on there. That could be an announcement soon. So I'm just saying, you never know. Like, it's a fluid situation at the end. If there's a treatment in 2 months and we get out of this and there's $6 trillion behind us as a wave to get everything kind of back, I mean, because it was meant for a bridge and to kind of give us a push back to normal. How long is that discount window for deals? So you have to understand, deals are today, right? Like, if you're going to try to get a seller to hit that bid, and that seller needs to be completely fearful. that they're hitting a gap down bid of 20, 25. So if you're going to have a 50, 60, 70% fall sustained over time, you know, that has to be the market for a long period of time. So if in 3 months from now, there's some good news and the stock market's starting to recover and hopefully jobs are coming back. I mean, I hear you on that. That's a problem. Jobs are a problem. What does it look like? All that kind of stuff. We haven't seen the bankruptcies yet. We haven't seen the defaults yet. But again, did we price all that in? But then we get the real life reality of it with people. Those people have to sell assets. I agree with you. We're going to have to go through a period of that, 100%. But at least they're going to be listing property for sale in a market that's not 7,000, 8,000 units of inventory. All right. I really, 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 really wonder how that inventory is going to come back, whether Peter's going to be right on that call and we're going to see a huge spike over a 2-month period and everything just comes back and we shoot up to 7,000 where we should be. Or if that's just going to slowly in step kind of get higher and it might take 6 months or 8 months or whatever to get up to 6,000 or wherever we were, 6,500, who knows? Be a very interesting question. These are good questions. Any other questions here?
Kevin had a question here. Kevin says, what discount ranges are you hearing from other agents in the new dev market?
I'm not hearing, I have no information on the new dev market in the last few weeks. I've been trying to figure out, I've been asking colleagues, but no one's comfortably giving me any information. The only information I have is really more the resale market, and it's from about 12 or 13 different agents I talked to, and deals are limited. You know, like one agent had 1 deal and the other agent 2 deals. It wasn't like they had 10 deals done. Very, very limited. And the range was between 5% and 25%. Right. Yeah. And the 5% one was a low end property, and the 25% was like a $6.3 million property. And again, you're going off of these brokers, what they think is the Corona discount. So they're like, yeah, I think we would have gotten 5% higher. We've gotten 20%, you know, so this is like the Corona discount they're trying to talk about.
Got it. And it seems like, I mean, from my understanding, is a cash buyer, right, that can close quickly with a new dev that's ready to close, you know, is going to get a much better deal.
Oh yeah,
than someone financing. So this is creating a big arbitrage between a cash and a financing buyer.
Yeah,
obviously for speed of close and things like that.
Yeah. Brandon has a good question from 12. How accurate do you think the stock market's projected economic losses are? I have no freaking idea, Brandon. I mean, look, the stock market's completely goosed. I mean, all of it, everything is so freaking goose. And again, I have on my video page, I have a YouTube. You should share this. I have a YouTube from January 30th from, it was a Rebney downtown committee meeting. All right. And I was talking about, the stock market towards the end. And I said the stock market is completely goosed. This is before it was completely goosed. Like it really was. It was priced for perfection. It was in mid-January, like a pinprick, anything touching this thing, like a little twig passing by, it would have popped this stupid bubble. You know, it was really priced for perfection. It was just completely the juice. So here we are, and you had major debt deflation kind of thing, and debt contraction and destruction. And the Fed just put in $6 trillion to reflate it. So now we're looking at projected economic losses. I have no idea. I don't even know how you calculate that kind of number. And in terms of the stock market, I mean, how do you price risk? I mean, I just risk is mispriced. It's juiced. It's an engineered market. It's a rigged market. It is what it is. Again, putting aside right or wrong, you know, I don't agree with what they're doing. It's not really the best thing for down the road. At some point, there'll be a price to pay, but they have no fucking choice. They got to do it, and they're trapped. You know, so I don't know the number to that. You could see the stock market do crazy things. You could see the stock market. I would not be surprised to see record highs in the stock market within one or 1.5 years. I would not be surprised at all. Because of what they're doing.
A couple other questions in there. So it says, when the stimulus money runs out in 4 to 6 months, would we see a massive amount of foreclosures as owners have had a forbearance on their mortgage? I mean, yeah, you're gonna have a cycle there. Yeah, you're gonna, and same thing in commercial, and it's gonna hit commercial hard. It's gonna hit small businesses. How much of that is priced in already? I don't know. I mean,
Yeah, that's really the question. Again, you get into these situations where the foreclosure numbers come out, yet the stock market and the real estate market just ignores them and they do their thing. And the reason is because they already kind of priced it in and they looked at it, and now they're looking at today and ahead. They're not looking at what happened in the past. You know, so again, the question, yeah, we're going to go through that cycle. Is it going to depress us? Is the stimulus money not going to be enough to kind of reflate out of that? That's really the question. It's hard to fight 6 trillion that could become 10 trillion, but there's going to be this type of pain. How could there not? I just don't know if that's going to be like you wake up one day and you see the news about foreclosures. All right, is that going to now cause a disruption in all the markets? And I just don't know. I don't think so.
Cool. I want to just be conscious of everyone's time. I know it's
of course. Yeah.
This has been super helpful, though. Anyone have any other questions before we sign off?
They have we think it's in the bottom of the stock market. Watch credit spreads. Watch credit spreads. I personally, I think we will, but I've been wrong on that so far. So I've been expecting a retest of the lows, and as we get higher and higher, and the numbers get kind of better and better, I'm wondering. I don't know about that. So I'm not as fully deployed as I would really hope to be. I kind of was hoping to buy a little more down there, but I'm looking at credit spreads. So as long as credit spreads are coming in, look at that BAA chart that I think Jared shared. As long as that keeps coming lower and lower and lower and lower, we're not going to see a retest of the lows. Not anywhere in the near term future. If you wake up one day and Boeing is nationalized, and there's a credit event of a major, like a Lehman Brothers, again, that we haven't experienced it, and the Fed's trying to mitigate that. They're trying to prevent that. But if you wake up one day to a shock, you might have a 15, 20% down period in a 5 or 6 day period. In which case, yeah, you could retest the lows. I was kind of thinking that was going to happen. And that we're going to wake up one day and either an energy sector or an airline or a travel industry. I mean, I wouldn't touch those guys. One of them was going to come out really, really bad and start a domino effect, a trickle effect, ripple effect, whatever you want to call it. And yeah, it was going to retest the lows. Now I'm just wondering with everything the Fed doing and goosing everything. So you got to watch credit for disruptions.
Kevin says, as a trader, what percentage move would you look at in the credit spread, which shows an inflection point?
Yeah, I think I know Kevin. Hey, Kevin, how you doing, buddy? Lucky for you, this is how crazy I am. I am building a system. I registered creditspreadalert.com.
Nice.
And I am literally in the process of building a credit alert system that me and John are going to test for like the foreseeable 3-6 months, tweak all the settings that incorporate all these different metrics we look at. We're going to have to pay a bunch of quants, a bunch of machine learning guys to do this for us. It's going to be a bunch of money, but I basically look for like a 5 to 10% deviation to kind of announce like a little bit of an alert to keep an eye on it. So that's, but when I build this credit alert system, it's literally going to be a visual that does it for you. So keep an eye out, creditspreadalert.com. It'll probably be out there in about 2 months or 3 months. I'll have it out there.
Awesome.
Well, thanks guys.
Thank you, Noah. Really appreciate you taking the time.
Yeah, anytime, guys. Be safe, and if there's any questions you got for me, just shoot me an email. Otherwise, be safe.
Sounds good, and we'll see you on Tuesday for the tutorial on how to use your tool.
Awesome. Thanks, guys.
Have a great weekend, everyone. Thank you.
You too. Bye-bye.
Bye-bye.